I'm joined now by our Director of Public Markets, Hoa Quach. We are going to change it up today and talk about the first quarter and then also talk about the first 2 weeks of April. This has been one of the more volatile periods of my lifetime, along with the dot-com bust, Lehman and the Great Financial Crisis, and COVID, a fourth major market event. Hoa, welcome. Perhaps you can start with how we got here.
Great, thanks, Joe. You mentioned COVID. That's where I'm going to start. About 5 years ago, almost to the day, we had COVID, the lockdown. And if you remember back to that time, there's a lot of uncertainty and a little bit of panic, right? And so we saw stock markets collapse around the world. The Fed and other central banks reacted to this by slashing interest rates to near zero. The federal government got into the act and enacted fiscal stimulus measures to provide the economic relief. I think the CARES Act was to tune of like 2.2 trillion, Joe. I mean, that provide direct payments to individuals, expand unemployment benefits, pause student loan payments, just a variety of things. But it was quite a bit of money put into the economy. And as vaccines were rolled out, the lockdowns lifted, we had pent-up consumer demand, global supply chain issues, and of course, all that money floating around from the stimulus. That really increased inflation. For about 20 years, we've been averaging inflation around 2%. And depending on what measures of CPI you're looking at, it got up to like 7 to 9% post-COVID. And sort of that was, inflation. The Fed at first was like, it's transitory. We're not going to do anything about it. And then once they realized maybe inflation was kind of here to stay, they started hiking rates. We saw some of the highest and quickest rate hikes in the last 40 years. So in that period from 2022 to 2023, we saw rates go from near zero to 5.25%, 5.5%, which leads us to today. One of the things I didn't mention was the rise of AI.
Yeah.
I mean, that definitely had some of its roots in the COVID response. As we went through this digital transformation,
Jumping on Zoom all the time.
yes, and going back to the stimulus, there's all this money, zero, very low interest rates. So there's a lot of investment in technology. So that really helped to ramp up this AI, development. And that has been such a major impact on the stock market the last few years.
And the Mag 7 really took off from January of 23 and was a story we've talked about quite a lot.
Definitely. And, we still see high interest rates. They're still there. Inflation still is high. And then, it may be rising. And one of the causes of this, increase or continued inflation is tariffs, which are starting to play out. And we actually don't know the full impact of that yet, but that's something that's really on top of mind right now.
All right, so that's a great background to talk about the recent drivers of the economy. And what we're going to do now is we're going to borrow a chart that we used at the conference forum yesterday. This gives us some further color. This talks about where we were, say, post-financial crisis in the 2010s, and then where we are today, kind of teeing it up for investors to think about the differences. So we've got here secular and cyclical drivers. And how about you take cyclical and I'll take secular? But just so the audience knows, cyclical are more short-term and tied to the economy, and secular are more long-term and less impacted by market swings. I like to think of like cyclical is like a vacation, something you're going to cancel if the economy is weak, versus secular, that's like a doctor, you're going to go to the doctor no matter what. So what do you think about the cyclical today and how we stand?
Right, Joe. Just for comparison, if you look at the 2010s, we were coming out of the global financial crisis. So, growth was steady, but, a little bit on the lower end, around 2.3% at that time. We had inflation was low, it was around 2%, and the Fed policy was pretty easy money. I mean, interest rates were near zero
Cheap.
during that time. And then we get to today, as I talked about, post-COVID, things are a little bit different. Coming out of COVID, all that pent-up demand, we had really strong growth. I think we were approaching 6% at one point in 2021. But it's been moderating. The last few years, we've seen sort of a slower decline in growth rates, still above what we saw post-GFC, but more in the 2.6, 2.8 range. But the outlook for 2025 is a little bit lower than that. We're going back to sort of the 2 to 2.3% growth that we saw post-COVID or post-GFC. Inflation, well, we talked about that. It still remains high. It's definitely above target, and yeah, we'll see where that goes. But I don't see it getting back to the low inflation that we saw in the 2010s anytime soon. Fed policy, we're still seeing high Fed funds rate or
Okay.
higher than zero. So that's where we are today.
And quantitative tightening.
Yeah.
Well, then looking at the secular drivers, so geopolitical risks are elevated. I think that's and globalization is retrenching, probably accelerated in the last 3 months. Um, the business backdrop is reasonably supportive. AI, as we kind of talked about, positive. Valuations are in question, and energy is also a question. I think it'll depend on this administration. But I think to take the broad, looking at the columns on the left and the right, on the left, these columns are a lot of green, meaning a lot of tailwinds. And on the right, we've got yellow and pink, meaning that we're trying to say is there's more headwinds to the economy and even to asset prices now in terms of both policy and valuations than we had, say, 10 to 15 years ago. So now we've gone over the past 5 years and then teed up a little bit of what 2025 looks like, versus past history. We know what you're thinking. We want to talk a little bit more about tariffs and client questions, but we're going to quickly review fixed income and equity performance for the first quarter. So why don't I start with equities? What we can see on this table here is something looks very different than the past 2 years. And you can see the mega cap portfolio down at the bottom at negative 15%. And what we saw during the year was the market topped out in roughly mid-February, and there was a large rotation out of U.S. stocks and into international stocks. So looking at the top here, you can see at the top is 4.6% is global stocks or international stocks, meaning that you saw a 15% rally in Germany and 15% rally in China. And again, leading up to the tariffs and leading up to some of the tariff anticipation, the rotation is something we haven't seen in quite a long time, but we'll talk more about how that's looking in April. But can you tell us a little bit about fixed income for the quarter?
Sure, Joe. So looking at fixed income returns for the first quarter, with yields falling, we were expecting bond returns to be relatively strong. The Bloomberg aggregate was just under 3% for the quarter. But given the volatility in March, the riskier parts of the fixed income, such as credit and high yield, were positive, but in the end, Treasuries still outperform at just under 3%.
All right, let's move on now to client questions, and Hoa and I will take turns answering them. We're going to start with, are tariffs inherently negative for the economy and for portfolios? What I would say to that is a metaphor that we've used is a knife. A knife can be used to open up a package from Amazon. It can be used to open up the birthday card from your mother. A knife can also be used as a weapon. With tariffs in themselves are inherently bad. And in theory, the tariffs, as we've seen them in the last month, it's about the style and the methods, meaning the style by spreading tariffs across the entire globe, only to then focus on just China, and then the method of not negotiating in a back room, but instead negotiating on social media. And I think also, while there's also the thought of whether they're structural or whether they're used as a negotiating tool.
Right. And, if they are structural, we can expect inflation in the short term and maybe even for longer. And, perhaps growth is hindered as companies are, maybe holding back investment because of these tariffs.
I think the other thought on the structural side is, will we end up focused on certain individual items? Microchips, steel, lithium.
Right. I mean, definitely we saw the risk to not having, production of those,
During COVID.
during COVID. And so there's, case to be made for that.
I think one of the other questions we're getting is how are the markets reacting with such volatility? My short answer to that was poorly, but maybe you can add a little bit of context to my.
Well, yeah, the market is priced for perfection, meaning that stocks are richly valued, credit spreads are low. In all reality, we may have had a correction without Liberation Day, but the way that these tariffs have been introduced, the on-off nature, pausing and increasing tariffs, I think that has just really introduced so much volatility in the market. And as we all know, Joe, the market does not love volatility.
Well, and thinking of the market and the volatility, let's talk about the reactions. One of the questions we are also getting is this market reaction in line with historical norms? And let me take a stab at this. Top to bottom, had 19% correction from the highs in Feb 19 to this week in the S&P 500. So we had a 28% correction in fall of 2022. We had a 34% with correction with COVID. We had a 20% correction in fall of 2018, the last time we had tariffs. So unfortunately, 20%, 15 to 20% corrections happen once every roughly 4 years. They're always painful, and they'll have varying triggers. The last question we're going to talk about is, as of today, April 11th, what is the latest news on tariffs today?
Okay, well, Joe, before we started this conversation, what we saw is that China hitting back with the tariff wars, raising their tariffs on the U.S. to 125%. Consumer sentiment has dropped to one of the lowest levels in a decade. Major stock indices have been negative, although a little bit more moderate than we've seen earlier this week. And with that spike that we saw on Wednesday, the S&P 500 is on track to finish the week in positive territory. Gold is at an all-time high. The U.S. dollar fell for a fifth straight day, while the euro has surged. And the 10-year Treasury yields increased to over 4.5%. And that's, as of this morning, could change by the end of the day.
I think it's worth mentioning, too, that some of these things are not necessarily expected. The dollar falling when we're introducing tariffs is kind of the exact opposite reaction you might have. And then bond yields rising, meaning treasuries are being sold, is also not the reaction we'd be expecting. So one of the challenges is that this is like kind of like maybe the other four big events that we've seen. This is a very unique situation, and we're not seeing markets react as they might have previously.
Sure.
Well, thank you for attending the webinar. Thank you for the questions. Please keep sending questions to Wespath. Please reach out to your representative if we can help you with anything further. We appreciate your partnership, and we look forward to seeing you at the next webinar.